Alright, in this lesson we're going to be having a look at why do we have market structure. So why do we have higher highs, higher lows? Why do we consolidate? And why do we have lower lows and lower highs? We're also going to be having a look at, do banks actually hunt for your stop losses, and why the market moves in the way it moves. So let's get into it. So as I said in the previous video, if you've seen that, you know that the foreign exchange market is the largest financial market in the world. $6.6 trillion go through it daily. Remember that number, 6.6 trillion. The Forex market is open 24/5 and has three main sessions: Tokyo, London, New York. Most of the movement happens in New York, followed by London. So we have Wall Street opening up for New York, and then London, I don't even know what it's called, but it follows Wall Street. Next, we have us retail traders, so people sitting at home on their computers. We don't make a dent in the market, and that is because $6.6 trillion goes through it daily. So if you pulled up everyone's wealth together as a retail trader and you put a position in the market, it's not going to move it at all, because these banks are the real players in the market. And they will move price up and down and fill orders, and we just have to follow them. That's our job. So as I said, the banks and institutions move the market, not us. Who do you think is putting $6.6 trillion through the market every day? This is daily. So institutions and banks move the market for two main reasons. So they execute orders for customers and to close off their profits. So remember the close off their profits as well. So it's called the market for a reason, because it works the same as any other market in the world. You need buyers and you need sellers. Every time someone places a buy, there needs to be someone placing a sell. Otherwise, who are they going to sell it to? Every time I hit the buy button, someone somewhere is taking an opposite position to me in the market, or to you. This is why the market moves up and down. So what I'm next going to say is important. So I do want you to write this down or take a screenshot, do whatever you got to do. But it's important to understand this. So a key fact about central banks or governments or institutions with big money is every time they buy, they must become a seller to take their profits. So you'll see in the markets why we have these moves up, and then we come back for a pullback for them taking their profits up the top. So what does this mean for us retail traders? Every large move in one direction has either a pullback or a reversal that follows. This has to happen so these banks can make their profit. Price isn't just going to go in one direction forever. It's definitely 100% going to have pullbacks. That's just what we see historically. There must be a profit-taking move. If they never sell off, how are they going to be making their profits? Only after I realized this fact is when I became profitable, because now I know the market's going to be moving up and down. If price pushes up sharply in one direction with little sign of a pullback, we know that coming soon, these buyers are going to turn into sellers. So let's have a look at some charts. So as you can see, price is just going to move up and down. So we have a nice down movement, we stretch back up. Up movement, we stretch back down. Come up, come down, come up, come down. We're just filling out orders, come up, come down. So we can have a look with fib retracements, and we can mark out this nice big pull up, and we can see that it's had a 61.8% retracement on that move. Same with up here, we've come down from this, pretty much be the move where you'd mark it from. Let's just say here. So we draw it to the bottom of this move, from the top to the bottom of this move, and we can see that eventually with time we do have another 618 retracement, which where it reverses from. So price is going to have these pullbacks where these banks take their profits. Now you can also see levels where there's an accumulation of price, and that's where multiple banks are happy with where price is. So they're just trading in this level and they're happy with price is. So this would be a great target for price, because that's where price is accumulating, and that's why you sometimes see these people online targeting for accumulations of price. Now this is live, so I don't know where it's actually going to go, but as a betting man, I'd assume since we've had this nice big move up, I'm assuming that sometime eventually we're going to come down and retest this level of previous highs to either continue the move or reverse it. We don't know. You never know. And you can just see that price loves touching price at the same areas. So we have a level of supply here where it touched. Price has come up, touched it again, come down, touch this high, come down, touch this low, back to the high, back to the low. And it just moves between these zones. And these zones are here because this is where orders are sitting. So price would have come up, hit a bunch of sell orders, so it's sold off. But then it's also hit buy orders here. So this is the accumulation. Now when it's come back up and it's shot completely through it, meaning there wasn't enough sell orders here for it to come back down. So what price is doing right now is looking for enough sellers to move it back down. So what you got to do now is look for previous levels of where price was at to where sell orders might be sitting. So you might be looking up at this grid here. So if price hits that level, it might bring it down from there because that's where orders will be sitting. And you guessed it, it's probably going to come back to another level where other orders are sitting, which would be this high. You can see the orders. So here's just a little drawing I've put together. So we have our buyers, which is bringing the price up. We have our sellers bringing the price down, and up again, buyers, sellers, buyers, sellers, buyers. And that's just how it goes on and on and on. So from looking from a higher time frame, you can see that price is going to be moving up and down and up and down and up and down. And that's just what it does. But from a lower time frame, you're not going to see price just moving up and down and up and down. You're going to see it moving in legs like this, giving us market structure. So down, we might consolidate for a while, break out. It's going to move in legs as it goes up and down. It's not just going to be moving sharply in one direction, sharply in the other. It's going to have legs. So why do we have these legs? The number one reason why is because banks and institutions, sometimes they have to place massive trades in the market, and they're going to have to execute it in stages. And this is because, say they put a massive long order in at the bottom, price is going to need to find sellers. It's just like any other market. So you have to be able to sell to someone else. Someone has to take the opposite end of the trade for you to make a profit. So if they place a massive order at the bottom, they're going to have to wait for it to find sellers. Price can come back down so they can get a better price, and then they can add to that position for another long position. You're going to find more sellers, bring the price down, get a better price for themselves, and bring price up once again. That's the main sort of reason why. We also always see these impulse legs followed by a correctional leg or pullback, and that is when price moves sharply in one direction. It's going to have a pullback where these guys are taking their profits. So they're going to take their profits, so they're going to flip from buyers to sellers, which is going to give us a leg down. And then again, they might add to their order. So price movement, market structure. That's why we have it. The banks purposely move the market to try and find where people, aka banks and other big money, would like to take an opposite position to them. For example, if they want to go long, they'll need to find lots of sellers. And I've actually drawn a chart in the next slide, so we'll look at that later. Due to the buying power of large institutional traders and central banks, they can move the market to a location where sellers will be. They need the liquidity to bring the price down. So orders in the form of stops or pending orders. So this is sort of why we have support and resistance as well, and why you see price reacting to it all the time. The majority of orders in the market are either stops on existing trades or pending orders on future trades. These are placed in the same area as people are generally taught to do, so support and resistance. Let's take a look at a chart on the next slide. So here's an example here. So as you can see, they've put some long orders in and they're wanting price to come up. However, there's not enough sellers to take the opposite side of their trade, so price is going to continue to move up until there is. So you can sort of see there's a bit of support here, resistance, support, a bit of accumulation. And as you can see, when price does come up, let me remove this. When price does come up and hit this grey box, it's going to have some sort of a pullback because there would be orders sitting there waiting to get filled. These orders get filled, which bring liquidity into the market, which can help them continue the move up. And then as you can see, it hits this level here, which is another previous high where more orders will be sitting to bring the price down again. So here is sort of a better example of where orders will be sitting and these levels. So this is why whenever you see people talk about market structure online, you'll see higher highs, higher lows, and you can just draw a line across and you can see that price is just going to continue because it's flowing where orders are going to be, and it's going to flow and grab liquidity along the way. So this is a pretty good example here. So let's just say a bank has $100 million short, which is probably a small order for this move. Another one has 50 million long, so two separate banks against each other. They're trying to fill orders for their customers. Since there's more short orders than long orders, price is going to continue to come down until it finds, so 50 million short, it's going to come down. When price reaches the bottom, there might be like another 50 million at the bottom, which it hits, and now there's equilibrium, so it's going to sit in a range. When there's equal longs to shorts of the big money, it's going to sit in a range, and that's why we see ranges. Now, as soon as the tables flip and there's more longs than shorts, we're going to start seeing price coming up again until there's another order for shorts, and then price is going to come down again. It's just going to keep moving up and down, and that's how simple it is. So here's another example here. So we can see we have lower lows and lower highs, but why doesn't it just drop instantly? Like I said before, it needs to grab liquidity. So as you can see, we sell 50 million, for example, and it's going to come down. It's going to fill these orders at the bottom where they're longing maybe 30 million. It's going to have a leg up, and they're going to then continue their sells because they've found these buyers. So now they've got rid of, from the 100, they got rid of 30. So they've still got 70 million to sell off. So they're going to sell it off again, and they're going to hit another level where there'll be some buyers. They're going to buy it up. Now that they've had that liquidity, they might have another 30 million to sell off, which they can finish off. So now that they've completed their massive $100 million short, at the very bottom here, at this nice level of support, there might be a $500 million position going long. So now this is going to continue going up and moving in legs until they complete that new $500 million long. So that's going to bring price up until it hits another level where another order is going to be sitting, and price is just going to move up and down continuously. Alright, so there's going to be stops waiting above previous highs and lows where big banks are going to have their money waiting to get filled into the market. So as we can see, we see the market start to turn. We set our stop loss above the previous low. So we might have it come up here, and then you might have a nice double top you're seeing, and then price comes down a bit. You set your stop loss above. However, you don't know that there's a big bank sitting by your stop loss with an order waiting to be filled. So they know this. They're going to bring the price up just to fill that big order that's waiting to be filled to grab the liquidity, and then it's going to continue the move down. This isn't them hunting your stop loss. This is them simply bringing price to a nice big order that they've seen by looking at their ladder, and they're going to continue the move down. So if you use a stop loss, it could get frustrating because you've set it right where a big order's waiting. So they're just trying to grab liquidity and your stop loss is sitting right there. That's unfortunate because you lost, and the move does end up playing out anyways. So we also have pending orders at breakouts. So this is where you kind of see fake outs, and you see people getting faked out all the time. But it's not hunting stop losses. So let me explain. The common type of order placed in the market is when price reaches a certain level, typically support or resistance. So we're in a range, and we have our resistance and our support. So we see price break slightly above, and we think, hell yeah, it's going to keep going up now. However, instead of just continually going up, what the market is doing is grabbing liquidity from a big order sitting there, and then it's going to continue the price movement down. So it's grabbing that order just to bring the price down. It's important to say that the market doesn't move like a video game. Just because it breaks up above a level, it's not going to just continue to go up to its next level. It's just filling orders from big banks. So it's going to fill the order and go down anyways. It's not playing by certain rules and saying, because I've broken out, I'm going to continue up. So do banks hunt for our stop losses as retail traders? The short answer is no, they do not. The long answer is that we as retail traders do not even make up 5% of the daily Forex volume. This is according to the Bank of International Settlements. This is legit. This means that we are so insignificant that banks hunting our stops alone wouldn't provide them with enough liquidity to justify the effort. We're such small fish in this pond of trading. So banks do not even think about us as retail traders. That's how insignificant we are. The real issue is that retail traders tend to place their stop losses in predictable locations, such as just above old highs or below old lows. These are the same areas where large institutions are looking to enter or exit their trades. This is just simply a slightly better price for them. When price reaches these levels, it's not because the banks are hunting individual stops, it's because they need liquidity to fill their massive orders, and they're not getting their liquidity from us, as we only make up 5%. So we might see that price is coming up and down and up and down, and it comes up to a level of resistance where we want to short. We're expecting price to come down. So we put our stop losses above, and price comes up, hits stop losses, and then comes down. And now you're thinking, what have these banks done? They've just purposely hunted my stop loss. But you don't know that actually slightly above this resistance, there's a massive bank order waiting to get filled. So price is going to go fill that order and then come down. And that's why we get these fake outs. So instead of thinking about stop hunts as a conspiracy theory against us retail traders, it's better to understand that liquidity zones exist, and this is how big players operate. If you can recognize these areas, you can avoid getting stopped out unnecessarily and even taking advantage of these moves. So I've actually put these two next to each other just to show you guys that banks do not even trade looking at charts like what we see. This is what we see price charts. And banks trade by reading ladders. These are order ladders. So what you'll see is where bigger orders are sitting, and that's where price is probably going to move. It's going to move to where these orders are so it can fill them. And us retail traders just stupidly seem to put our stop losses right in between where the big order is going to happen. And you can see it. If you know this, you can see it on the charts playing out all the time. So this is Tom Hugard, and he is as reliable as it gets when it comes to trading. He's been on multiple trading floors and worked with multiple banks. And I've just added this in the video so you can see this is his reaction to being asked if banks hunt stop losses.
So now into really quick questions.
Sure.
Do you think that banks and institutions hunt for retail CFDs traders stop losses?
No, please don't.
Nice.
Now, here's the thing. What I want to say to you is this.
Also, you worked on a CFD broker, so...
Yeah, but bollocks to that. No.
So I do cover this in another lesson, but this is just something so you can think about. So what do we know about the market? First of all, we have no control of the market. We don't know where these liquidity orders are sitting from the banks. Second thing is we can't accurately time our entries. How are we going to time it if we don't know that there's going to be a massive order sitting just outside the breakout? We don't. The third thing we know is that the market's just going to move up and down as it fills orders. And it's going to jump between ranges, highs and lows. It's just going to make waves, and we just have to surf them. So all we really need to do is know how to take advantage of these three facts right here. So hopefully what you've learnt from this lesson is who trades the financial markets and how insignificant we are as retail traders, how little of a percentage we make up, and how we don't even make a dent in the markets. Hopefully you also understand why we have market structure like higher highs, higher lows. It's just simply orders being filled out and grabbing higher orders to bring price down or bringing price up from these other massive orders from other bankers. And hopefully you also understand that banks do not have the effort to hunt our retail trader stop losses. So thanks for watching. Hope you learnt something, and subscribe because I've got more free shit coming out.